my name's James Nicholson and welcome to my YouTube channel. In this video, I want to redo a video that we've done about 6 months ago because the market's changed significantly. And that's where we compare 2-year mortgages against a 5-year mortgage, because this question is coming up daily in the comments on videos related to mortgage rates, because some people just need a little bit of guidance on where they should go. Now, to preface that, I want to make it very clear, I am not a financial advisor. You should always go to a broker and look at your own financial circumstances, because everyone that watches this is in a different scenario. And some of you have a big appetite for risk. Some of you like certainty. And it's also important to know which is best for you financially as well. So that is a consideration when you're thinking about should you take a 2-year deal or a 5-year deal. Now, before we jump into this, as always, if you haven't done already, do subscribe to the channel over there and hit the bell notification. We've got new content every single day on this channel, all about property investing, mortgages, interest rates, house prices, and much, much more. We're on the way to 25,000 subscribers. Your little subscription over there will really help, and there's lots in it for you as well. And while you're here, smash the like button, tickle the like button, do something to that like button, guys. That really helps me with the YouTube algorithm. It gets more eyeballs on the channel. It's a little signal to Google and YouTube to push this out to more people. So take a moment to do that. So what do? There's 2-year deals, there's 5-year deals. What should you be focused on at the moment? Now, let me explain with my portfolio of 10 properties what I'm doing as they come up. So properties that I have personally that have a decent amount of equity. So I've got some properties that have got 80% equity in. I've got others that have got 25% equity in because maybe I bought them at different times or added value and various different things like that. So the ones that have got 25% equity, could be a new deal, right? We've got a new deal going through at the moment. So that will have 25% equity in it straight away because I put my deposit down. It won't have gone up in value or down in value at that stage. So that's more of a risky deal. So on those types of deals, because the market is a little bit more uncertain at the moment, I can't say with confidence that house prices are going to go up over the next year or 2 years. I can be more confident over the 5 years. So where I've got a small amount of equity like that, I'm looking at a 5-year deal. I feel that's the better kind of deal for me. And that gives me that security should the market drop. Because if I have a buy-to-let property and the market goes down 10%, and then I'm on a 2-year deal and I've got to refinance and the market's dropped, I'll actually have to put in more deposit because I've got to make sure I've got that 25% equity still, and some of that will have been wiped out. So that's important consideration there. Now, on the deals where I've got a decent amount of equity in there, I've got one with 80% equity in that property, I'll be more banking on the fact that I personally feel rates will come down in the next 2 years. And so those ones, I'll take a 2-year deal, right? Hopefully that makes sense. So let's look at the pros and cons of a 2-year deal. So a 2-year deal normally would have lower rates. So you should normally find that the interest rate is lower. Now, right now in the market, that isn't always the case. There will be some lenders that they feel that rates are going to drop. And so they want to get people tied in for longer on a 5-year deal. So they're actually getting better deals on 5 years. So go and have a look. But normally in normal times and maybe going forward past summer this year, you'll see lower rates on a 2-year deal. You can switch sooner, right? So let's just say rates do drop. You're going to be locked in for less time. So if you get a deal today, then you can be looking in 2026 at what the better rates are in that time. You're not locked in. There's no penalties to leave that lender. And so you can move on to that. So if you are confident that rates are going to go down, then that could be an option for you. Then you've got lower repayment charges as well. So the repayment charges will be lower because the deal is a shorter deal. So lower repayment charges should you decide to drop a new deal and move on to a new deal. So what I mean by that, let's just say you took a deal out today, then in summer, Bank of England slashes interest rates by 4%, goes close to that 1% target again. You can leave. Because your deal is only a 2-year deal, the penalty for leaving will be lower than it would be on a 5-year deal. So that's one good thing here as well. Next, because also the rates are lower, normally you can overpay. So that overpayment, you'll have more cash available to overpay. Now, the cons are that you've got a risk of higher rates at the back end. So let's just, and that's what's happening to people right now, isn't it? So there's tons of people right now that are coming off a 2-year deal into these high interest rates, and it's hammering them, and they're really not comfortable with what's going on. So you've got that risk there. There's less peace of mind, so you can't predict what's going on. So there's less certainty with that kind of deal as well. You don't know what your rate's going to be in 2 years, right? There's less predictability and certainty. What else? I'm just reading through my notes on this, sorry. That's it. So let's look at a 5-year deal. So on the 5-year deals, the pros are certainty. So that one's less certainty. Well, the pros are the opposite, aren't they? So you've got that real understanding on what you're going to be paying every month. And I've got tons of friends that just like that. They like to know what they're going to be paying every month. They don't want the roller coaster investor ride where it can be highs and lows and all that kind of stuff. They want to know what their monthly payments are going to be. So certainty is a real important thing here. You've got more chance of capital gains. Right, so there's a higher chance your house is going to go up in value in 5 years, especially in today's market, than in 2. The outlook for property at the moment is that prices probably will be lower by the end of this calendar year. Not loads lower. I don't think there's going to be a crash, but there could be. Right, it's definitely possible that house prices could crash. They went down 1% in March, so if that carries on for the rest of the year, we will officially have crashed in 2024. And so locking in for 5 years allows it to go through that cycle and be going up again. And it's more likely in 5 years that your house will have gone up than it will have gone down. There's also less stress is important as well. So that's important. Now, what are the cons of the 5 year? Well, the cons are you might miss lower rates. So that is a con for a lot of people. That's not great. And so, yeah, your circumstances might change. So if you lost your job or something like that, that could also be a difficult situation to be in. So you've got to really weigh this up for you as an investor, as a homeowner. What do you feel is best for you and your family? Are you someone, so let's look at this in a nutshell. 2 years is for someone that wants a little bit more risk. You're confident that interest rates are going to drop in the next few months or year, right? You're confident that that's going to happen. Now, a lot of us were confident and they were going down. December and January this year, prices, mortgage rates went down, but they've started to go up again. Inflation's gone up again in the UK. The Bank of England are saying on one hand, the inflation is going to go up in the UK at the end of this year, but the economists are saying it's going to come tumbling down. So who's right? That's what we've got to figure out there. 5 years gives you certainty, but you could lock yourself in at a really high rate because rates at the moment are around 4%, 5%. If you lock yourself in 5% for 5 years, then the rates go down to 3%. That's really going to annoy you and frustrate you. So you've got to weigh up the pros and cons on this. What would you pick? First off, as I said at the beginning of the video, go and speak to a broker. They need to see what your financial situation is. But do comment below, do smash a like, do subscribe, go and check out some more content on my channel, including this video right here.